Hey everyone, and welcome back to the Tesla Stock Podcast. The wait is over. We finally have Tesla's Q2 delivery numbers, and the market's reaction might surprise you. After a week of intense speculation and political drama, the dust is starting to settle. With the stock now trading around the $316 mark, there is a ton for us to break down today. So let's jump right in. Our top story, of course, is the big reveal. Tesla's second quarter production and delivery report. Tesla announced they delivered 384,122 vehicles in Q2. Now, on the surface, that's a 13.5% drop compared to this time last year, and it marks the second straight quarter of year-over-year declines. It also came in just shy of the official Wall Street consensus of about 387,000. But here's the twist. The stock rallied nearly 5% after the numbers came out. Why? Because heading into the report, sentiment was overwhelmingly negative. Some of the more bearish forecasts were calling for numbers as low as 342,000. So, as William Blair analyst Jed Dorsheimer put it, investors feared worse. This inline number was seen as a win, providing some reassurance that demand is just slowing down, not completely spiraling. It was a classic case of not as bad as we thought, and the market breathed a collective sigh of relief. Wedbush analyst Dan Ives said the July 4th fireworks came early for Tesla. He noted that, after months of weakness, Tesla saw a rebound in China in June, which he calls the heart and lungs of the company's growth story. The feeling is that maybe, just maybe, the worst is behind them for now. But let's not get ahead of ourselves. While the delivery numbers weren't a total disaster, our second story digs into the serious headwinds that are still very much in play. The reality is, the demand picture is complicated. Even with Elon Musk back full-time at Tesla after his controversial stint in government, the damage from that period seems to linger. Before the report, J.P. Morgan analyst Ryan Brinkman warned that weak demand had persisted through the quarter, and he actually projected a much lower delivery number of 360,000. His concern, which is shared by many, is that Wall Street is counting on a huge turnaround in the second half of the year, even as EV subsidies are under threat and the global economy is shaky, and there are signs of internal turmoil. It was reported that Omiyad Afshar, a longtime executive and trusted ally of Musk, who was head of operations for North America and Europe, has been fired. This isn't the kind of move you make when everything is running smoothly. It suggests there's immense pressure to fix the sales slump in key Western markets. Personally, I think this underscores the fact that while the delivery number provided some relief, the underlying issues of competition and brand perception haven't gone away. Musk himself said that they may have lost some sales, perhaps on the left, but gained them on the right. Politically, but a 13.5% year-over-year drop shows that the net effect is still negative. So this brings us to our final segment. Where does the stock go from here? The Q2 report has really highlighted the deep division in how Wall Street values this company. On one side, you have bears like J.P. Morgan's Brinkman, who is maintaining a sell rating and a $115 price target, implying a massive 62% downside. They see a company whose core auto business is struggling and whose valuation is disconnected from its fundamentals. On the other side, you have the bulls, and even some neutral analysts who argue that deliveries are becoming a secondary metric. For them, it's all about the future. As William Blair's analyst noted, investors are more concerned about the Robotaxi rollout, and momentum in the shares will follow that closely. The limited launch of the Robotaxi service in Austin has completely reignited the narrative that Tesla is not a car company, but an AI and robotics company on the verge of its next major growth phase. This explains the recent volatility. The stock got hammered by the renewed online feud between Musk and President Trump, only to roar back on delivery numbers that were simply less bad than feared. We even saw Cathie Wood's ARK Invest buying another 56,000 shares on the dip. This isn't trading on fundamentals. It's a bet on a disruptive future. So to recap, we got Q2 delivery numbers that were down year over year, but beat the lowest expectations, giving the stock a relief rally. However, serious questions about demand, competition, and internal stability remain. And finally, the valuation continues to be driven less by car sales and more by the long-term, high-risk, high-reward bet on robotaxis and autonomy. That brings me to my question for you. Now that the Q2 numbers are out, what are you watching more closely for the rest of the year? Are you focused on a potential rebound in vehicle sales, or is it all about the robotaxi progress? Drop your thoughts in the comments below. I'm always curious to hear your take. And if you found this breakdown helpful, do me a favor and hit that like button. Subscribe to the Tesla Stock Podcast and ring the notification bell so you never miss an episode. Thanks for tuning in, and we'll see you next time.